We have a major stock absolutely collapsing after our Salesforce, a $260 billion market cap company, is down over 17% after hours. We're going to talk about what happened here, and we're going to talk about, is Salesforce stock a buy? Is this a buy the dip opportunity in this video? C3AI just reported their earnings. The stock's moving up 7% plus after hours. We're going to talk about C3AI. Do I like this? The stock kind of gets put into a category with Palantir stock. Do I feel like I need to own this one additionally on top of owning Palantir stock? UiPath, this stock is down over 30% after hours right now. This, I gotta say, things might be a little interesting in regards to this one. I'll share that in this video here today, okay? American Airlines is at pretty much multi-year lows right now. We're going to speak about if American Airlines is a buying a dip opportunity here. Walgreens cutting prices on 1,300 items. That news broke here today. That's after last week. Target announced they're going to cut prices on up to 5,000 items. Walmart, we're hearing about price cuts. McDonald's is trying to do a $5 combo. All of a sudden, everybody's getting real serious about pricing, and so we'll speak about, is this actually good news for the economy overall? Does this mean people are going to be put into a better position if we're talking about actual deflation in countless items out there, okay? Alrighty, a lot to get into in this video here today. Appreciate y'all joining me as always. It takes less than 3 seconds. All I ask in return, hit a like on this video and make sure you're subscribed here to the channel if you're not. The pinned comments down there today, I'll put my Instagram. If you're on Instagram, you want to follow me on there, I'll put that as a pinned comment along with X if you use Twitter, formerly known as Twitter. Now it's known as X. I post a lot of stuff on there daily. That will also be pinned comment down there. So Salesforce, what's going on here? Why is it crashing? Is this a buy? Okay, well, here we go. Look at the headline. Salesforce shares plunged 17% on first revenue miss since 2006. 2006? I was in high school in 2006. Oh my gosh. That's 18 years ago, right? Now, first off, that's a blessing and a curse. Because it's a blessing that, man, if you haven't missed your revenue numbers since 2006, like, you're doing pretty freaking well as a company. Like, that, like, clap it up for you. That is amazing. Like, you are a real creme de la creme, top tier company. If you don't miss a revenue in 18 years, come on, man. But it's also a curse. Because when it finally does happen, everybody says, what? This is downright scary, right? That's what everybody's looking at this and they're like, this company never misses, and they miss. Something's either got to be going wrong in the economy or something's got to be going wrong with this company specific for them to actually miss, right? And the last time they missed was right prior to the great financial crisis, right? Which kind of caused a little more concern out there. And I call this kind of the curse of being a straight A student. If you're a straight A student, all of a sudden you come in with a C on your report card, everybody's looking at you like, whoa, what's going on here? Are you getting into bad stuff? Like, why are you getting a C on your report card, right? That's Salesforce here in this situation. That's why everybody's freaking out and the stock is absolutely collapsing, right? So when we look, their EPS actually they did $2.44 adjusted versus $2.38, right? But their revenue very slightly missed. I mean, very slightly missed. $9.13 billion versus $9.17. Put me to sleep, okay? Yeah, first miss since 2006. Okay, but gosh, come on, man. I mean, it's almost the same flip and flapjacking number. It's a rounding error. It's literally a rounding error for this company. But we got a bigger problem here. As far as the guidance went, they're calling for adjusted EPS of 234 to 236. Now, analysts on average were expecting 240, so slight miss, but it is a miss nonetheless on the guide. And then as far as the revenue guide, they're talking about $9.2 billion to $9.25 billion for the guidance, right? Well, analysts were at $9.37 billion. So we're talking over $100 million difference there. That's basically a double miss on the guide. No bueno, okay? Now, when you look at their income statement, it's very important to understand. I understand the stock's crashing, all this stuff, but at the end of the day, you got to grade these companies fairly. I graded this income statement. That's a grade A income statement. Is it an A plus? No, but is it an A? Abso-dang-lutely. Very good numbers. Subscription support, they grew that nearly $1 billion year over year, right? Professional services and other was down a little bit. Total revenues went to $9.1 billion from $8.2 billion. Subscription and support as far as cost of revenues was barely up. Professional services and other was actually down slightly. So they kept their cost of revenue they kept in a great place overall. So their gross profit went to the moon. They did nearly $7 billion in gross profit for $6.1 billion in the same quarter last year. R&D, they did up that a bit year over year, about $150 million roughly, okay? Sales and marketing, they did bring that up a little bit year over year, but the company's growing revenues very nicely. So, those are right in where they should be. G&A, general administrative, they kept that pretty in check, right? And they didn't have a big restructuring expense. So their total operating expenses actually brought that down significantly year over year. Income from operations went to $1.7 billion versus $412 million in the same quarter last year. If you look at their net income, $1.5 billion versus less than $200 million in the same quarter last year. And their diluted EPS, $1.56 versus 20 cents in the same quarter last year. Gotta clap it up for them. Very, very good income statement, right? And then if you want to know about the balance sheet, well, this is pretty sweet. Cash and cash equivalents is right around $10 billion for the company at this point in time. Marketable securities is $7.7 billion for the company. So, you add up those numbers there, and we're talking close to $18 billion in cash, cash equivalents, and marketable securities. Very impressive. Very, very impressive as far as that goes, right? Then additionally, if you look at their non-current debt, they basically kept that in check on a year-over-year basis, so which means their balance sheet is strengthening overall. I like that. Now, in terms of valuation, trying to think about, is a stock a buy or not? So obviously the stock's going to be down heavily tomorrow. The question is it down more toward 10% or is it down more toward 20%? I think that's the only question about the stock price tomorrow, right? But if you look at this company overall, forward P going into these earnings was around 28. So obviously the stock's going to be down huge tomorrow. And we can say maybe analysts are a little bit too bullish in their EPS estimates. So I think the true forward P is probably 26-ish on the stock right now. Maybe 25, but probably 26-ish, right? Well, we got a company here that first off, they put into more of like a SaaS category, right? Which those business models are the holy grail. They're going to always trade at a premium versus a market. And then additionally, this company is expected to continue to grow revenues at, let's call it high single digits percentage, right? 9% or so. And then EPS is expected to grow a little faster than that. So when I look at it from that context, I gotta say, it's actually, is the stock a buy? Yeah, it is a buy tomorrow. Now, is it as attractive of a buy as it was at the end of 2022 and the beginning of 2023 when it got all the way down to nearly $100? No, it is not that sort of screaming buy, right? But the bottom line is, if this stock's in the 220s tomorrow, it's a buy. And then if it dips lower than that, and let's say it goes to 200, 180, it continues to be a buy. Now, to hope this stock might go to $100, $120, $140 again, don't hope on that. And the reason being is, the only way you're going to get this stock to go there is in a stock market crash. That's the only way you're going to get this stock to go down there. Based upon where the valuation's trading at, kind of the growth rates, only way I see that is in some sort of market crash. And you don't want to base your investment decisions based upon hoping the market's going to crash. That's never a very good thing to do. If you ever get that blessing and the market crashes and you get to buy stocks for insanely cheap prices, you take advantage of that. But don't wait to buy stocks to hope a stock market crash happens. A little food for thought in regards to that. So this stock is a buy, great quality company. C3AI. A lot of people put them into a category similar to a Palantir. Some people call them a Palantir competitor. I might feel a little different about that, but a lot of people call them a Palantir competitor. So C3AI is up 7% after hours. Now, the first thing, I got to give the company respect. Those headlines are very nice. They're increasing their revenue growth. They're raising their guidance, right? Growth accelerates for fifth consecutive quarter. Accelerates, keyword. Record federal growth. Subscription revenue for the fourth quarter increased 41% year over year. Respect. Those are really, really nice headlines. But the headlines only get you so far in life. What about the actual numbers? This is where things go to the D way, okay? Check this out. So subscription revenue looks great. Almost 80 billion. I'm still on Salesforce's numbers. Almost $80 million in subscription revenue versus $56 million in the same quarter last year, right? Professional services was down massively for them, right? 15 million plus in the same quarter last year, 6.6 in its most recent quarter. So total revenue was up, we can call it about $14 billion or so on a year over year basis, just over $14 billion, right? As far as cost of revenue, subscription cost of revenue went up substantially. So that hurt a lot of the, gross profit, right? Professional services, they brought that number down massively, so that's good for them. So total cost of revenue, the good news is it didn't go up as much as the revenue went up, right? Which means your gross profit's going to go up, and that's exactly what happened. Gross profit was up about, we can call it about $4 million roughly, a little over $4 million year over year. Now, problem is they spend a fortune on sales and marketing. I mean, here's the deal. Your gross profit's up a little over $4 million, but your sales and marketing's up close to $12 million. No bueno, no bueno. Research and development for the company, that number was up a little bit for the company year over year, only about $1 million. General administrative, that was up about $600,000 for the company year over year. Total operating expenses, the total operating expenses way outweighed in terms of the growth of that, right? On an absolute basis, way outweighed the gross profit growth. So it means your losses are going to get even bigger. And that's exactly what happened here. Interest income was up for the company year over year. Thank you, Federal Reserve, for that, right? But net loss was up substantially for the company year over year. So sure, they're bringing in more revenue, but what for when your losses are up worse than they were before, right? They already lost a fortune in the same quarter last year, right? Nearly $65 million net loss in the same quarter last year. And now their net loss is nearly $73 million. So what's the point of bringing in all that extra revenue if your losses are getting bigger and bigger and bigger? So that's the issue here with C3 AI. Now, additionally, the balance sheet is getting worse, right? If you look at total stockholder equity of this company, actually went down on a year-over-year basis, right? Not also something you want to see, but at the end of the day, if you're losing a bunch of money, guess what's probably going to happen? Your stockholder equity is likely going to go down unless you can raise capital or do something like that, right? So when I look at this, do I feel like I need to own C3 AI? The answer is absolutely not. Now, that does not mean C3 AI is going to be a bad stock over the next 5 years, but at the end of the day, much rather be in Palantir. Not even a question to me. For Palantir, I'm getting a better income statement, a better balance sheet, a better cash flow. I'm getting a better brand, right? I'm getting, in my opinion, way better products. And in my opinion, I'm getting a way better CEO. And there's no shade to C3 AI and what they got going on. It's just somebody's got to be the winner. Somebody's got to be the chicken dinner, okay? I want the gold medalist. C3 AI is not the gold medalist. They're somewhere back there in the pack, okay? That's the difference. So I don't feel like I got to own that stock. I'm very happy owning the best company in that space, which is Palantir, okay? UiPath, $12 after hours. Stock's down 30% plus. This might be an opportunity, okay? Might be. I got to do some more digging here, but might be something here, okay? So this is the way UiPath describes their business. The UiPath business automation platform. From insight to innovation at the speed you need. Discover, automate, operate, right? Okay, transformation is the way of working. There is no finish line. See how automation and AI are the catalyst for continuous reinvention. So this is a business that didn't tell us that much, okay? I'm going to need to do a lot of digging in regards to the actual business model here and see what the heck's going on. But I will say I like what's going on here. Now, you may say, wait a minute. I graded this income statement a D+. How could I be even interested in this company if I graded a D+? Well, check what I found here, okay? Licensing revenue went up quite a bit for the company year over year, about $6 million roughly. Subscription services is what flew to the moon for the company. $146 million the same quarter last year. They did $185 million. Professional services and other also grew. So total revenue grew very nice from $289 million to $335. So this is a nice growth company, right? But look at the cost of revenue. For licenses, it hardly went up for the company year over year, right? Like that's literally like nothing. You might as well call it flat, right? And then if you look at subscription services, that was up for the company, but not even remotely close to as much as revenue was up for the company there, right? So that's significant. Professional services and other actually fell for the company year over year basis. So total cost of revenue went up, but not even remotely close to at the pace that total revenue went up, which is a very good sign. Gross profit for the company went to $279 million versus $245 million, right? Now, additionally, sales and marketing, they spent a lot more on that. So that's kind of a downer for the company. That was up about $20 million year over year. R&D was about $10 million, which you could understand. The company wants to continue research and development, considering they got this sort of growth. G&A was also up for the company. So total operating expenses were up quite a bit for the company. Operating loss was up a little bit. Interest income was roughly flattish. They all did have other income bring in there, but they were able to cut their net loss a little bit, right? Which is nice to see. And I'm also looking at kind of these categories, and I definitely see places they could cut here, right? Definitely see places they could cut there. And so the fact that they brought down that net loss a little bit, and then I still see places they can cut, but at that sort of growth rate, they can probably not really hire in a lot of these categories moving forward in any substantial way. And that revenue will likely continue to kind of likely go up quite significantly. So that makes it actually somewhat attractive, right? And on top of that, additionally, I found this. If you look at their balance sheet, cash and cash equivalents for this latest quarter, over $1.1 billion. And then marketable securities, a little under $800 million in marketable securities. Keep in mind, with the stock crashing the way it is, the market cap on this stock should be around $8 billion tomorrow, somewhere around there roughly, right? So we're talking about an $8 billion market cap with almost $2 billion in cash and cash equivalents and marketable securities on the balance sheet with that sort of growth rate. And it looks like a company that likely next year will probably flip to profitability, right? And so that's what has me really, really intrigued here. I got to do more digging on this stock. But if you're wondering, is this a stock I could buy? It might be. I've got to understand the business fully, exactly what they're up to, what gives them competitive advantages. I got to run SWOT analysis in this company, strengths, weaknesses, opportunities, and threats. I got to look at all that for this company, and then we'll see. But there might be something here. Might be. So my hope is actually the stock goes a lot lower. And then my hope is I like what I see, and then maybe this is a move I make. But we'll see. There's a lot of opportunities in this market. That's the problem. Next one up here, American Airlines. This stock is near multi-year lows right now. It crashed almost 14% here today, right? Down to $11 a share. Is this stock a buy? Well, these stocks are never a buy. Airlines are never a buy for people like me. We're investors. I'm thinking about stocks for the next several years. I want to be a shareholder. Ideally, when I buy a company, it doesn't mean I'll always hold a company for 3, 5, 7 years. But when I go to buy a stock, I've got to feel comfortable if I could not sell that stock for the next 3, 5, 7 years. I will basically never invest in a stock unless I feel comfortable holding it for many years. Does not mean I'll always hold every stock for many years. I might, if I buy a little stake in a company and the stock goes up 20, 30, 40, 50% really quickly, I might cash it, right? But when I go to buy a company, I got to feel comfortable holding that company for years. Could I ever say that about airlines? And the answer is absolutely not. No, you can't hold airlines for years. These are trading vehicles only. They're not meant to be long-term investments. And if you want the proof, let me show you the proof of how bad these stocks really are. It's so bad that I would look at something like this and I would say it's better off to be in like the S&P 500 versus airline stocks, literally, right? So I wanted to kind of look at like 20-year performance of these stocks overall, right? So I went back as far as I could. I couldn't quite go to 20 years on American Airlines. TradingView has them as of 2005, so I'm guessing they had some sort of split off or something back in 2005. The stock's down since that time, down around 44%. So we're talking about almost a 20-year performance that's been absolutely awful for this company overall. Absolutely awful, right? Check this out. This is Southwest Airlines, arguably the most well-run airline of the bunch, right? And this is a 20-year chart of Southwest Airlines. The stock has gained a whole 52% in 20 years. And you look out there and you think about how many great companies have performed so tremendous over the past 20 years. And you even think about just simply being invested in the S&P 500 or the NASDAQ, right? And there's a reason Warren Buffett, I learned very early on to not buy these stocks because Warren Buffett preached against buying airline stocks. He used to preach against it all the time, right? Like, you don't want to own these stocks. They're trading vehicles only. Look at United Airlines. I backed this one up as far as it can go, and it went back to like 2005. Maybe they had some sort of split off between them and American Airlines back then. But nonetheless, folks, look at the performance. It's almost 20 years, and the stock's gone up 23%. 23% in nearly 20 years? Come on. That's just awful. Absolutely awful. Awful performance, folks. So the moral of the story is there's certain stocks in the market that are basically never worth owning. Traders, if they want to trade in and out of them and they think they can get in and out, fair. But there's a big difference. You've got to understand there's a big difference between a trader and an investor. You're a trader if you're thinking, I'm going to try to flip out of the stock next week, next month, tomorrow, whatever, right? Trying to get a little gain here and things like that. If you're an investor, you got to be mentally in a place that I'm fine holding that for the next 3 years, 5 years, 7 years. I don't want to hold any airline stock for the next 3, 5, 7, 10, 20 years. No. There's so many better opportunities. These stocks don't perform. They're bad. They're poor. And they're like that for a lot of different reasons, right? One is it's a competitive industry. We know that, right? And pricing can get very competitive. And everybody sees all the pricing that's out there, right? On all these different websites, Expedia and all the other websites that people use to ever book travel. They see it all, right? So, it's hard to command a premium. And a lot of people look at the flight and they say it's the same dang thing. Some people feel differently, right? They feel, I feel differently on a Delta airline versus Spirit airline. Fine. But a lot of people, they don't care. They'll just look at it and they're like, I need to go from, Miami, Florida to Massachusetts, and I need to go there the cheapest way possible. And so they look and they're like, okay, this is the cheapest seat. Okay, boom, I want to book it that way. That makes pricing tough, right? And it's hard to differentiate between this company and that company. Then additionally, on top of that, these companies have ridiculous maintenance fees. We all know that, right? To keep these babies up and running and not have any incidents, it's very, very costly. We know that, right? They're very susceptible to recessions. They're very susceptible to fuel increases, so going through some sort of inflationary environment. They're very susceptible to wages going up in a significant manner, right? They're very susceptible to if a health scare happens. We saw that in Rona. And so there's just so many problems with these companies. Oh, and did I even mention the debt? These companies usually take out incredible amounts of debt because guess what? If you want to order these planes, they're very, very expensive. It is not cheap, right? And then they get hit with their airport fees and this fee and that fee. It is. I'm telling you guys, these stocks are they're trading vehicles. Sometimes if they're really beat down, and you're looking at it from like a 6, 12-month perspective, could there be money made there? Sure. But at the end of the day, you got to say, am I a trader or am I an investor? And you get into a lot of trouble if you try to be both. A lot of people try to be both. They think, I could be a trader. I could get in all these stocks. And I could be an investor. I can hold long term. Doesn't work that way. There's such different mentalities. It doesn't work over the long term. I've yet to see somebody that's really a truly great investor and a great trader. You're either over there or you're over here. There's no such thing as being both. You're either over there or you're over here. And you have to figure out which one you're camping. I don't want to be trying to chase a little money. I don't want to try to be in and out of stocks. And no, I want to be able to buy a stock, hold it for years, make a bunch of money on it. If there's any major crashes or corrections in the market, I could buy more of that stock. Great. Build my portfolio of 15, 20 stocks and have a day. Okay. Keep track of it all. See if there's a new great opportunity out there for me. And that's that. And I don't have to worry about all the in and outs and, oh, crap, man. None of that. None of that. Okay. So the moral of the story, and that's not the only group of stocks that's like that. That's just one group of stocks that's like that. And do keep that in mind. Okay. Now, let's speak about this subject. So you're hearing all these stories, Walgreens cutting prices, Target's cutting prices, Walmart's cutting prices. All of a sudden, all of these guys are starting to get serious. Their numbers, a lot of these guys, Walmart's numbers have actually been pretty respectable. But a lot of these other companies, their numbers are not very respected. Their stock prices are in bad places, right? They're significantly off of the highs many of these companies reached years ago. And so they're having to adjust. And so their way of adjusting is they're thinking, okay, we've been going up on price considerably on our customers the last couple of years, and it's clearly not working for our numbers. We need to go the other way before we completely lose out on this game. That's what they're thinking, right? And so you got to ask yourself, is this good for the economy, right? Because when you first hear about it, it does sound like, okay, this would be good. Walmart cuts prices, Target cuts prices, Walgreens cuts prices, right? They get into a price war, and then they got to lower prices even more and more and more. And it's like, seems like, yes, this is great news, right? We're going to be able to buy a box of Band-Aids and a bottle of Tylenol cheaper than ever, right? So that's the theory, and I can understand that, but doesn't quite work as well as you might think, okay? So here's a look at the United States inflation rate over time. Now, what's important to understand about this chart here is you see this massive crash here. This was during the Great Financial Crisis, and we actually went into deflation. Deflation. That means prices as a whole are going down, right? It's not something that almost ever happens, but it happened there. And other than that, before that, you got to pretty much all the way go back to like the 1950s, like the 50s, to find like a deflationary cycle, right? Incredible. It's a very rare occurrence. You might think, that's great. It doesn't really work like that. Because if you look, right, prior to the Great Financial Crisis, right, we had actually a significant amount of inflation in the system. It was not as bad as it's been for us over the past few years, but it was very bad, right? Look at July 2008, 5.6%. Now, if you go back to actually the unemployment rate for that first half of 2008, it actually wasn't that high. It wasn't that high at all. But then when inflation started falling, and it started falling dramatically, and companies and businesses, they all got into a deflation price war, it led to deflation, but it also led to a major unemployment cycle, right? And that unemployment cycle started to kick in toward the end of 2008 and then got obviously very, very nasty in 2009. And then the employment markets continued to be in a bad place in 2010, right? So it gave everybody a break in terms of pricing. Pricing got a lot more attractive. But on the flip side, if you lost your job, right, or your job decided to give you a 40% pay cut because they weren't making as much money in the Great Financial Crisis, it's not like that was necessarily great either, right? So that was kind of a haves and have-nots. If you were able to still make just as much, right, let's say you were able to make just as much from your income in 2009 that you were in 2008, well, it was phenomenal for you because prices just sank massively, right? Deflation actually in the system, which almost never happens, and you were making just as much, if not more, then you're in a great position. But for the people that lost their job, right, or they lost their job and they went and found another job, but their old job paid $75,000 and their new job paid $55,000, so what? Milk's a little cheaper and eggs are a little cheaper at the store and a pack of batteries is a little cheaper. If you're making $20,000 a year less because you lost your job and you had to get another job and your new job's not as good as your last job as far as payment goes, it's not ideal, right? So that's the scary part of this. You can't ever get too excited about some of these things you hear. When you hear something like this and you think this is going to be great for everybody, it might be good for some people, but just understand it's not necessarily great for everybody. But it is interesting because I was thinking recently, I'm sure you guys have noticed, like obviously fast food places that went up on their price significantly in 2022, 2023, right? And anything fast food, quick related, became very expensive. And it is, some of these places, if you want to go for your family, it's now $30-$40. And that's just like a crazy price for like fast food, cheap food, quick food, right? But and I was thinking back to myself when I was in college, and I ate a lot of fast food back then, college kid, like you're going to eat a lot of fast food, Taco Bell, Burger King, all that type of stuff, right? And I was thinking back then, I never spent more than $2 or $3. And I ate a lot of food back in college, and I never spent more than $2 or $3 at any of those fast food places. It was always either $2 and something or maybe $3 max. Never more than that. I was on a tight budget too because I wasn't making much money. And I was just thinking, like, could you do that today? And I was like, no, give me a break. Like, no, it's almost impossible to, if you eat a decent amount of food as a college kid, it's almost impossible for you to eat for less than, it's almost impossible to eat for less than, I would say about $6-7 at any fast food place nowadays, right? So, yeah, don't be surprised. And I'm seeing in the real world, though, like I'm seeing more and more of these places becoming much more value conscious, much more price aware. if I go to some of these fast food places now, I'm looking, they're starting to bring back some of the value menus. They're starting to do promotions like, oh, if you come through this time to this time, you're going to get, 3 chicken tacos for whatever price or whatever it is. Starbucks, I'm getting more and more emails from Starbucks. They're sending me these emails about buy one, get one free on this day from this time, right? Starbucks, if they ever did a promotion like that, it was insanely rare in the past. Now I'm getting emails, it seems like every week from Starbucks about, we're doing a buy one, get one free drink. We're doing 50% off drinks from this time to this time on this day. That's a sign of definitely more deflationary environment, right? That's a sign that things are getting much more competitive for these guys, and they're like, crap, we got to run up volumes because, their businesses just aren't as strong right now, right? So, a little food for thought in regards to that. No pun intended. Hope you guys enjoyed today's video. If you use Instagram, you want to follow me on there, that will be the pinned comment down there. If you use Twitter, now known as X, and you want to follow me on there for updates, I'm always posting a lot of stuff on there. Check out the second pinned comment down there. That'll be to follow me on there. Much love and have a great day.